All right, good morning, everyone. Welcome back to the office hours. It's been took a little bit of a break in August, and it's a very special show today because it's the last show that is featuring my wild hair. The curly-headed rebellion is coming to an end. I just had my bachelor party, and I'm getting married at the end of the month. So here it is in all its glory, guys. Soak it in, and then no more. We're gonna
I'm
let a
surprised you
few
guys
more people
are
trickle.
showed up for the bell today after that bachelor
Yeah,
party.
it was a fun time. It was the altitude that got us. I think we were up at 9,000 feet, which I'm sure my heart doctor and Daniel's heart doctors weren't crazy about. But it was a fun time. I mean, we were up in a cabin and really up high in the woods in the mountains. There wasn't anyone behind us, and there was actually a pond behind us. So one of the days we had a moose join the bachelor party for about a half hour, and then the morning we left, not 48 hours ago, we were checking out some elk in the backyard. So it was a really little different than a normal bachelor party. I don't think usually have moose and elk at typical ones, but it was fun nonetheless. So yeah, I think we're back up to speed from that, and we got everyone here. So I think we're going to talk about the thing that everyone's kind of worried about today. I know we've covered it in our columns, we've covered radio before, but it's just so important. We got to talk about this Nasdaq and S&P just blowing everything out of the water because globally diversified investors, myself included. I mean, I'm sitting here watching this thing like, pulling my tons of hair out over it. So I think people are wondering, gosh, is this normal? Has it happened before? How long can it go on? I know, Dave, you got some slides on that, but Dad, as we were talking this morning before the show, you were kind of mentioning, well, welcome back to, was it the late 90s, you said?
Yeah, I'd say we're probably towards 1999 at this point. And the reason I say that is because 1995 to 1999, basically the Standard & Poor's 500 index pretty much doubled the returns of the global index. But if you look over what happened after that, and that David will probably get into that, it doesn't end well. And I think we'll probably end up summarizing that this is either one of those once in a lifetime, once in a generation opportunities to own not just the S&P 500, or it's not. It didn't end well for large growth companies for the next decade, where they put in a total return of minus 10% versus small value was up, I don't know, almost 200%. Just as an example, emerging markets was up probably 100 plus percent. All the asset classes that were involved in a global portfolio that were doing well, they just weren't doing as well as the stuff that was getting outrageously overpriced. And when you pay too much for something, and I'm not going to make an argument that things are wildly overpriced. I could probably make an argument that the Standard & Poor's 500 index is way undervalued. But still, what you pay for something matters. Imagine buying IBM at the end of 2000, or at the very beginning of 2000, because it looked like large growth companies were the things to own over the next 15 years. Earnings for IBM doubled. I don't know if you guys want to take a guess for what happened to its stock price. So you guys don't know.
It stayed the same, I think.
Yeah, it did. So it went nowhere. So it's just a valuation issue. So David, you might want to get into that. I mean, so look, it's interesting. It's an interesting dynamic. A global portfolio is kind of returning what it should historically, kind of in line with the average returns for a historically global equity portfolio. It's just that the largest growth companies are probably at this point earning 200% of their normal historical return. So that's so much. The gap is more about it's all in. It's back in the 70s. So in 1973, 74, Warren Buffett wrote an article basically saying, well, you pay a dear price for buying into the cheery consensus. And we had a horrible bear market in 73, 74. And so it really reminds me of that nifty 50 area. There was going into the mid 70s, it was called the nifty 50, which were basically these 50 companies that were where all the return was at. And they got crushed in the 73, 74 bear market. That's not me saying that's what's going to happen. That's what Warren Buffett's saying is you pay dearly for an overly cheery consensus payment. And if you look at everything else, they just didn't get hit quite as hard. But now we're in this nifty five, I'll call it. It's the Amazon, it's the Facebook, Netflix, Google, etc. So now it's even more concentrated, I think, than it was in the early 70s. But it really doesn't tell you anything about the future. But I think valuations do matter in the long run.
Well,
I think,
go ahead.
I was gonna say, I think one thing too that can easily be forgotten is that clients who are looking potentially at the S&P 500 or looking at the Nasdaq and saying, "Wow, look at this difference in run up and return." It's probably helpful to keep in mind that our clients anyways, own those stock holdings and the components of their mutual fund. So it's not that they're also not participating in the growth of these companies. It's a simple and a permanent decision to say, I'm not going to own just the S&P 500 or just the Nasdaq. I own those stocks, but I also own others. So I think sometimes that can be somewhat of a disconnect to say, oh, if I only owned the Nasdaq stocks, then I'd be doing better. Well, you do already own those, just not explicitly or exclusively those stocks.
And
so
that's
you are
Go ahead, Dave.
that's kind of the whole point of global diversification or diversification in general is you don't want to live and die by, I think people think of diversification in terms of individual stocks, but you also want to think of it in terms of asset classes. And what I mean by that is just like types of stocks. So if you look at all the companies that my dad mentioned, they're all basically the same or similar type of stock in terms of they're huge size companies, they're growthy in terms of their like price to earnings ratio, and they tend to be all kind of like tech dominant stocks, at least right now, the ones that are kind of dominating.
Like 1999.
You don't want to live and die by the performance of one asset class. If you put all your money in one asset class, you're going to have times where it crushes everything else. It just shoots the lights out. But you're also going to have extraordinarily bad periods. And the whole point of diversification is that you own a lot of different asset classes, a lot of different countries, a lot of different companies, and your performance by its very nature is going to be somewhere in the middle of all of those. At any given time, one of the asset classes in your portfolio is going to be doing a lot better than the others. And one's probably doing terrible and some are probably doing mediocre. And your overall blended performance is somewhere in the middle. And I think sometimes people struggle with that primarily during times where the asset classes that are outperforming are the benchmarks you see on TV. Like you didn't hear anyone in 2000 to 2009 saying like, I'm underperforming emerging markets value by a huge margin. Like, why aren't we going all in on emerging markets value? Just because that's not a benchmark that people use, but that's really not any different than saying, I'm underperforming the S&P 500 index. It's like, well, yeah, that's one asset class, and it's the asset class that's doing really well right now. But as you said, there are time periods where it's going to do very poorly relative to a global portfolio. And so I don't know if anyone else has anything to add before I kind of get into some of the numbers, but I thought we could go into just past few decades. So let me share my PowerPoint real quickly. I just pulled together some slides.
Yeah, when actually we were on the bachelor party, and then I'll let you go, Dave. We were seeing these old mines, old gold mines, and someone said, a ton of people came out here because they heard that they were going to strike it rich, and they heard a couple good stories about people finding gold, but most of them didn't find anything. And I think it's not just in America, but it's human nature to hear, well, that guy's getting rich over there, I need to go do that. And then you actually pony up and go, I'm going to put all my eggs in one basket. I'm going to go out to California and find this gold. But realistically, most people didn't find it. And I think that's just the herd mentality of, well, if someone else is getting rich, I need to get rich too, even if maybe it's detrimental to your long-term life. So,
yeah, I mean, we're in the business of making sure our clients' well-being is improved upon over their lifetime. And that has nothing to do with relative performance of one asset class to another. It's having a plan. And by the way, we don't have a single client plan that isn't near over funded status. I don't have a single client who's been with me a decade or two whose plan isn't considerably better than what we had planned on the initial day. And over my almost 4 decades now, I've been through a number of periods when diversification sometimes sucks. At least it appears to, but it's always working. The fact that everything isn't going up the same magnitude or down the same magnitude is the essence of diversification. So global returns have been respectable, but the biggest trap investors get into is, I think I've said this before, comparison is the thief of joy. Hey, we're all fine. And I might have mentioned this before. I've been lucky enough to tag along for free on a couple of trips to Europe and stayed on a friend's 150-foot yacht. I don't say that to impress anybody. I told you I was just a sponge. I was just sponging off people. But it was a very fascinating human dynamic as each yacht would back into the dock in Monaco. So these are pretty well-heeled people. And they were thrilled to be there. They were thrilled to stand at the top of their yacht, pull in, stick their chests out, usually with a 30-year-old wife for a 70-year-old guy. And you could just see the joy and the glee of, here we are in Monaco, we've made it. We have a yacht. We get to go to these yacht parties or whatever they were. And you could instantly see that joy drain from their face when another yacht would pull in that was 25 or 50 feet longer. I mean, 1 minute they're thrilled, proud, happiest maybe ever from a monetary sense. And then now they get to compare themselves to the yacht that backs up behind them that's cooler, bigger, longer, more expensive. And comparison becomes the thief of joy. That's really what we're talking about here on this topic. Sorry, Dave.
Well, and with investment performance, there's always going to be something that you could point to that outperforms you. Like even if someone was investing just in the Nasdaq, you could say, well, maybe I should have just bought Tesla stock. You can always, in hindsight, go back and be like, well, I should have done this. It's like, yeah, but it wasn't obvious at that time that you should have done that. And by the way, that can end really poorly when you start concentrating in a single company or asset class. I think one of the things that sometimes makes things difficult from a psychological standpoint, and Daniel and Paul and Ryan and I were talking about this the other day, is sometimes in the short run you get away with some reckless decisions and you're actually rewarded for it. So anyone who's been going all in on, Tesla stock or some of these tech stocks over the last year or so, they've just been continually outperforming and doing really well until eventually that probably won't continue forever if history is any guide. But in the meantime, and then the flip side of that is sometimes prudent investment decisions can look wrong in the short run. And Paul, we were talking about how your wife works for Abbott and she had some employer stock. I don't know if you wanted to mention that, kind of like what we were joking about.
Yeah, absolutely. And this came up because, one of our friends that we, David and I were in a fraternity with, is also a financial advisor, and his wife works for a tech company, and they keep selling her company stock as soon as it vests. And of course, the company stock is going through the roof. So he jokes that his own wife is going to fire him. And I had that same exact situation happen. My fiance was working for a company that was then called Thoratech. It's a heart device company. And I told her, you don't want to double down on the same risk. You don't want to own too much of your employer stock because you're working there and your economic fortune is already kind of tied there. Now, of course, what happened is Connie only put, a few thousand or something like that and cashed out when St. Jude eventually bought Thoratech like a year and a half later for like 3 times what she put in. Something ridiculous like that. So, it was one of those things that I call it terrible financial advice. I still stand by, because sometimes the prudent thing doesn't, it does cost you a little bit, but you have to go back and say, well, I still made the right decision based on all the information I had. And it could have gone the other way. You could have put all your money in your employer stock. Something happens to your employer. Now you're out of a job and you have no assets. It's just unfortunate that it went the other way. And we're getting into this with the Nasdaq because we've been telling people, this can't last forever. It's probably a little bit outrunning itself, and you probably shouldn't abandon, a diversified stock portfolio for it. But then that turns out to be wrong. And even, you know, I was struggling with this myself. I'm like, man, how much longer is this NASDAQ going to go and make me wrong in the short run? So those are just kind of difficult times, but you still just have to stick with prudent investment advice, because we're not necessarily trying to arbitrarily grow our wealth as much as possible. We want to reliably achieve our goals. So yeah, I've given some quote unquote bad financial advice that was actually good financial advice. It just turned out to be bad financial advice.
It's, you know, so much of that just is, it turns out to be based on what time horizon you're looking at. So if you're looking at periods of 1, 3, even 10 years, I think the mistake that people make is in human terms, that seems really long. It seems really like it should be meaningful. If performance has been a certain way for 10 years, surely that means something going forward, but it's actually not the case. And some of it does get down to, am I going to make my decisions based on recent past performance? And by recent, I mean literally as long as maybe the last decade. Or am I going to make my decisions based on evidence and research and what that suggests is the best way to invest over the rest of my lifetime? In the short term, it's going to be all over the place. I'm just going to ignore that noise. And again, just stick with my investment decisions that I made based on, as you said, you know, what's the evidence say is the best approach or the prudent approach to investing over my lifetime and will lead to the highest likelihood of achieving my financial goals.
But just think about and then I'll let you go to that, David, but think about the last 8 months. We've gone from many investors, sheer panic, wondering if the world's coming to an end in more ways than one, to now the concern is, hey, how come we're not earning as much as my brother-in-law? It's just fascinating 8-month period. The fastest 35% decline ever, followed by the best 50 days ever, and I think the best 100 days since 1933. This is a interesting year. The stock market will do everything it can to throw people off the great thrill ride before it gets to the fun part, which means it just seems to have this cruel behavior to get people distracted and get them to bite and chase shiny objects. And I've seen it. If there's the number one theme of being a financial advisor is dealing with that. Okay, Dave.
Yeah, so this is going to be rehashing some of what we've talked about, but I just pulled together a few slides, and you guys can jump in here too, just because I'm the one kind of presenting. You can add your commentary. But first thing I just pulled up was, I really liked this graphic. It's from a financial author called Carl Richards. And his whole thing is that he writes really simple sketches to explain important investment concepts. And I like how he basically says investing based on past performance is like driving using only your rearview mirror. Both lead to a lot of accidents. And a lot of what the following slides are going to show is how past performance is not indicative of what's going to happen in the future. And a lot of times chasing past performance and making decisions based on that can end really poorly. So the first thing I was going to show actually was just the fact that one thing to keep in mind is just because something is shown on TV and tracked closely by the general public doesn't necessarily mean it's a good benchmark or comparison for your portfolio. So I think one thing that I've noticed a lot lately is people are comparing their diversified investment portfolio to the S&P 500 or the Dow Jones Industrial Average, because that's what you see on CNBC. But those are very, very different investment portfolios. You think of, using the S&P 500, for example, that's 500 of the biggest companies in the United States. So it's one country, it's one asset class, and not only that, it tends to be, because it's market cap weighted, that means it's really dominated by the biggest companies even within those 500. If you look at a globally diversified portfolio, and what's shown in this slide is in the brown is Dimensional's equity balanced index or strategy. And that's very similar to kind of what we use. It's globally diversified. It has a little bit of a home bias, so it's more in the US than kind of the natural market would weight, but it does include international stocks. It includes small cap company stocks. It includes value stocks. So it's over 12,000 companies across the globe. And the point here is not so much saying, oh, this did better or worse, a certain number of times. It's always doing better or worse because it's going to own a variety of asset classes, and the S&P 500 is just one, and the performance is always going to differ. And so the S&P, if it's highlighted in green, that's basically saying the performance was better. If it's highlighted in red, it means the performance was worse than a globally diversified investment portfolio. Well, one thing, and we're going to look at some of these time periods, but you see, first of all, it's bouncing all over the place. But second of all, you'll see time periods where you go like 95 to 2000, where the S&P not only did better, but did better by a wide margin 5 years in a row. At this time, this is the 99 that my dad was talking about. This is when people were thinking, diversification's dumb, international stocks are just not as good as the US for a variety of reasons, whatever their rationale is. People wanted to go all in on US large company stocks, particularly tech stocks at that time. And then you look at the next several years, and the S&P did substantially worse than the global portfolio. So that's a perfect example of how if you're chasing past performance, you can get whipsawed. You can go all in on something just to have it basically revert to the mean and do poorly over that next block of time. And this is actually showing growth of a single dollar invested over certain time periods. And I thought it was just kind of interesting to look at. This goes through December 2018. So first of all, this will be worse going through today, but I didn't have this slide just went through 2018. You can see the S&P 500 if you invested $1 in the S&P 500 in 2010, it would be worth $2.71 today. A global portfolio would be worth $2.23. So it's substantially outperformed. This is what we've just lived through, and again, it's gotten even worse over the last, since 2018, it's gotten worse, so it's diverged even more. From an annualized performance standpoint, this is one thing my dad mentioned as well, was the S&P 500 has done particularly well. It's not so much that everything else has done horrible, it's that the S&P 500 has had above average returns compared to its historical average. U.S. large cap value is at 12.36%, and you see international has really been lagging. So international has been the biggest drag. Up until recently, it's been smaller companies and value companies have played a bigger role in that. Again, this is leading a lot of people to say small cap factor-based investing is dead, the small cap premium's gone, or the value premium's gone. International diversification doesn't make sense anymore. You're hearing all the same claims you were hearing in 1999. And so I wanted to show that decade of 1990 to 1999. It was even worse from a difference in performance. So this is when, especially this last 5 years, the S&P 500, the big companies in the US were just shooting the lights out. I think their annualized returns were like 20+% per year towards the end there. So again, huge divergence in performance between the S&P 500 and a balanced strategy. So just like today, you were hearing the same claims. You were hearing people giving up on diversification, giving up on value investing, wanting to go all in on growth stocks. But how did that play out over the following decade? From 2000 to 2009, $1 invested in the S&P 500 would have turned into 91 cents. They call this the lost decade because it's an entire decade where your money didn't grow if you were invested in the S&P 500 for your stock portfolio. Now, it wasn't a totally stellar decade for a global investment portfolio, but it was still pretty decent. You see $1 turned into $2.06. So this isn't saying this is how the next decade's going to play out. It's just an example of how chasing past performance can end really poorly and how past performance does not necessarily translate into future performance. If anything, there's probably a little bit of mean reversion in the stock market, just meaning if something's been doing well above its average, if anything, its expected returns are probably lower going forward and vice versa.
And we know that from the K10 ratio. There's a high correlation with when the broad U.S. market has a high CAPE ratio, which is just another way of saying some people think it's overvalued relative to historical CAPE ratios. The returns over the next 10 to 20 years tend to be really poor. Well, it was at a record place at the end of 1999, and for the last 20 years, it's been one of the worst 20-year periods for the S&P 500. I haven't looked at it since this year, ever. Sub 4%, but it might be now sub 5% per year. So it's another way of saying, yeah, what you pay for something matters.
Exactly. And then this is the last one I have, so I won't bore everyone, but I think it's just interesting to see the performance of different specific asset classes. So for example, this column's real estate. And again, this is that lost decade that people dug because the S&P 500 had a negative 9% growth of wealth. You look at a lot of the stuff that's doing the absolute worst right now is like international, emerging markets, anything value oriented. You start looking at those things, the things that are doing the worst right now, we're doing the best in this decade. So just look at emerging markets value index was up 427%. This has been a terrible performer recently, but it just goes to show these asset classes, they go in cycles. And again, this gets back to why we own a lot of different asset classes, because all of them are going to perform differently from one another, and they're going to have periods where they have really good performance and periods where they have really bad performance. And I'm going to go ahead and stop sharing and just keep talking.
Dave, let me do one update here real quick. Let me share just a quick update. Okay, so I'm going to go here since you didn't update them. So this is the whole period, 1970. Okay, so there's the S&P. The dollar's worth $150. That's pretty good, right? So here's the dimensional balanced equity index. So that's if you step back and you view, you say, wait a minute, I'm not sure there's anything wrong with this globally diversified strategy. Just as an aside, I'll show you, you mentioned that, it's probably been a little worse, 2010, and then I'll stop, I promise. Can you see that?
Yep.
So you can see that it has magnified. You were looking kind of here and here, but over since 2010, $1's $3.46, $2.30. That could lead a lot of investors to say this is bad, this is good. But if that's the case, are we going to use that 10-year period, or are we going to go back to that longer period? I mean, really, what's going to drive our decisions? Taking a longer perspective and saying, wow, I kind of like this better than this, but wait a minute, the 10-year return or more is favoring this one and the other slide. Anyway, you guys don't like it when I do charts. I know it.
No, I think that's helpful. And I think the point is not saying this is going to outperform in the future necessarily. It's just saying you can't look at a 10-year period and draw conclusions about what expected returns are going to be going forward.
Yeah. My guess is this, you will look back and we'll see this as the buying opportunity or the holding opportunity of probably for most of my clients over the rest of their life. It's not a forecast. I'm not saying it's going to happen. I'll be surprised 20 years from now if we don't look back and say, wow, we're glad we stayed diversified. But one never knows. That is why we call it risk, right? That's why we call it risk. Let's move on to another elephant in the room that we've been getting a lot of questions on, Paul. That's the election.
And yeah, I know Dave has some more slides on this. I think it really, whichever political party you're in, you're worried the other one, if they win, it's going to be the apocalypse. And generally speaking, that hasn't been the case. Now, Dave, I'm expecting you to have some numbers for this. Do you have them pulled up?
I do. So I'll go ahead.
See, there you go. That's why we have Dave on the panel.
Again, we're not trying to prove anything. We're just trying to make a point that, worrying about a market that's going to implode if so-and-so, that's not, implosion is not an investment strategy.
Right. And so this is showing real simply annualized investment returns for the Standard & Poor's 500 index during different presidential terms, going all the way back to 1929. And what you see is that it's a strong positive average regardless of the political party that's in office. And you can't really see any pattern or draw any conclusions from it. And I think the one response that I almost always get to this when I show people this is, yeah, but this time is different. We've never had a president like fill in the blank. But don't you hear that every single election? I mean, I have for the last two, which I've been, a financial advisor for. Just, Dad, curious to hear what your experience has been.
I've been through 9 of them. I've heard it 9 times. First time I heard it, the S&P 500 is at about 100, 120, let's call it, rounded down probably. So first one I heard was in 84 when it was just, and then of course the S&P 500, last I looked, was at about 3,400. I've heard it every time. Bill Clinton was going to be horrible. He's going to raise taxes. He said he was going to cut taxes, but now he says he's going to raise them. Going to be horrible. Well, I'd like to have those. I'd like to have the next 5 stock market years be the Bill Clinton years. I heard it when Obama, he was going to be the economic antichrist, socialist. I'm not saying that. I'm saying these are things I heard. Again, the world didn't end. And then, of course, then I had another half set of clients that were really concerned when Trump won. Maybe some of their concerns are true, but from a stock market perspective, I've never heard it not said, yeah, but this is different. And this one feels to a lot of people like, yes, the stake of the country is at hand, depending on what your view is. But this doesn't translate well into an investment policy. How do you make an investment policy out of that? I'm going to get out and as I think we explained to somebody the other day, David, is, okay, suppose you're right and you can predict the president. I put it at about 50-50 at this point. Not real good odds. And then you win and you pick the right call, and that your person you thought would win wins, or didn't, person you were afraid of or hopeful. And then now you have to tell me what the economy is going to do. 50-50 at best, probably not even that. And then you have to tell me, okay, if the economy is going to do that, then tell me what the investments are going to do. You're really starting to stack up some compounded, really bad odds that make the odds of making an investment policy correctly out of that are really way against you. You're better off in a casino. Trust me, you'll only lose your money. You'll lose it a lot slower. So I always get back, and this resonated with the client, and some of you've probably heard me say this before, that even if you can predict the president, then you got to predict the economy. Let's say you get those two right. It's 2009, it's March 9th. A client calls me, they've been sitting in cash. They happen to miss the whole bear market, the whole financial crisis in 2008, 2009. And they call me and they say, Paul, I've been sitting on cash. I'd really like to get it deployed. I think this bear market's almost out of bullets, or if it's not out of bullets, it's close to it, close enough. So tell me what the economy is going to do for the next 4 years. And I say, you know what, guys, I can tell you this is the first time in my life I've been able to do it. It'll be the last time. But I can tell you that the economy will not grow over the next 4 years from today more than 2% a year GDP. Not very good, and a 3% trend line GDP. Not very encouraging. And even though you didn't ask, I'm not going to charge you extra for it. Unemployment won't fall below 7% over the next 4 years. A lot of people are going to go, you know what, I think I'll just hang out in money market funds. That doesn't sound so good. 3 years and 9 months later, I call as I promised I would, and I say, well, Paul, I got good news and I got bad news. The good news is I was dead right on the economy. Never went above 2% GDP, and employment never went below 7% unemployment. Now, the bad news is the stock market's risen 2.5-fold. So this is, if people need to step back and think, wait a minute, do we know something more than the millions of overlapping minds know about who the presidents might be? Because they're betting on Wall Street over this. And so I got to get the election right. Then I got to call the economy right. And then if I can do those things, I got to be able to make sense out of it and know how to invest. Good luck with that.
And even if you were right, because generally people make these calls about, they're worried about the market going down. So let's say you even nail that and you get out and you miss the decline. Now you have to figure out when it's bottomed out and when to get
Right.
back in.
Yeah.
So you have to be right twice. And then some of it gets down to fundamentally, like, am I going to take a market timing approach to investing, or am I going to take a more disciplined buy and hold approach to investing? And you kind of have to decide that, because at the end of the day, I think if you attempt market timing once, and let's say it even works out well that time, the likelihood of you doing that consistently over and over again over your lifetime and not just ending really poorly from an investment return standpoint is so low. Like, almost everyone who tries to time the market ends up with very subpar performance.
And how about this? Timing the market is irrelevant to success. That's what history tells us. It's irrelevant. So why even go down a path that's irrelevant? I just don't get it. What I also find interesting is I could give every client, fill this in, because I'm going to write, and the market's going to fall 30 to 50%. Now you write in what's going to cause that, and they could all probably come up with something. The point is, every 4 or 5 years, the stock market generally gets to delight us with a 30 to 50% decline, average about 30% decline. So, okay, guess what? The stock market, regardless of who's elected, may go down 30% next year. That's part of owning equities. And the reason we own equities is because bonds never create or maintain wealth. Doesn't mean you don't own them. It's an insurance policy against being poor. Nobody wants to be poor. Our bond portfolio is there to cover poor and destitute. Okay? It's like an insurance policy. I pay my premium. Maybe it's $1,000 every year, fire insurance. My house burns down, they'll rebuild it. Well, why do I pay it every year? Because it's not going to burn down likely this year, and next year they're going to want another 1,000. It's insurance against something. That's where our bond portfolio is. It's not there to produce income. It's never produced any material income on real after inflation, after tax basis. These low rates are nothing new. It's happened many times before. Real interest rates, like what do I earn net of inflation? And now we have the Fed saying, hey, you know what? We're not too worried about 2% inflation. We'll probably let it run higher if it needs to. So we're in the ownership of the great companies of America and the world, precisely because without them, we're not going to make it out alive. We're not going to increase our well-being. We are not going to maintain our purchasing power over 2 or 3 decades, where that purchasing power is going to cause our cost to rise at least 3 times if history is any guide. We're not going to leave any meaningful legacy or security to our children and grandchildren. So big boy rules, big girl rules, I'll say, just to be equal. Guess what? Stocks will fluctuate. And if you think you can tell me when, okay, Dave made a really good point. All right, you get out, you call it, and the market falls 30%, and you're feeling really good. Think about this last crisis. Mohammed El-Rian, you guys got his name? You know, the guy that used to be head of
PIMCO or
PIMCO, one of the biggest bond
Yeah.
funds. Really famous guy. All through January, February, March, here's this guy saying the stock market's going to fall 30%. Wait to buy it. Get out. Blah blah blah. And then what was his advice, along with all the other pundits? Well, you get back in when it goes down to test the lows. Guess what? It never happened. The ship left the dock. It never came back to pick you up. You're stranded on the dock forever. Trip's canceled. Well, a trip's one thing. A retirement canceled? That's a problem. So I guess I'm gone on too long on that one.
Would it be fair to say, though, sometimes, so like these people who are switching strictly into the S&P 500, that is market timing. It's just timing asset classes.
Yes.
It's virtually the same thing, because I think sometimes they're like, no, I'm not a market timer. And it's like, well, you are. You're trying to time asset classes, which is the same thing. It's just at a sub level. So I think just
there's no
realizing
evidence
that too.
And there's absolutely no evidence that it can be done consistently. None.
Exactly.
Let's go try something. Can you imagine your doctor prescribing medicine? Hey, why do you think it's going to work? I don't know. The last few people with this new miracle medicine, they seem to do better. How about a little testing and a little evidence so it doesn't make sure it doesn't kill people later? I mean, theoretically, they'll test this vaccine, though. Now sounds like maybe they're not going to be so rigorous in testing vaccines. They're going to let them loose. But historically speaking, before medicine arguably takes too long. But most doctors are pretty sophisticated, and they're going to say, we'd like to see some evidence that this medicine and this treatment and this procedure actually works. Well, that's good enough for me. I mean, I think we ought to treat our money the same way. Hey, if we're going to do this, on what basis are we making the decision to switch from a global asset allocation to one where we're in one concentrated, basically 5 stocks? On what basis? I defy anybody to tell me that they could show me one published study that shows that that can be successfully done over time. Just one published study and I'll shut up.
Well, and I think Daniel kind of hinted at something. You know, we talk about how devastating it can be to try to time the market during a bear market when you miss out. But if you try to time different asset classes when one is doing really well and one is doing poorly, you might have the same type of a detrimental effect on your lifestyle. I mean, you could miss out on returns that don't come back. So that's just one of those things that I know we harp on. You know, we have a really easy time talking about don't panic out during temporary declines. And I think this idea of abandoning global diversification for a single hot performing asset class is just kind of the next war we have to fight with our clients and even with ourselves. I mean, I'll admit, like we have these tilts to size and value, and with the Nasdaq and S&P just blowing the lights out, it's frustrating. I mean, I personally am frustrated with it because you always think, what might have been, you know, if I had gone with those obvious Nasdaq stocks. You know, I had a lady at the dog park even tell me like, well, in the peak of the crisis, I just had my financial advisor pick like the 5 great tech stocks like Apple and Amazon, you know, the exact perfect time to do that. But that doesn't mean you're going to do it next time. And it's just
Paul,
as
that's like
dangerous.
saying, yeah. So I had my financial advisor take a pistol out, put 5 bullets in the 6 chambers, spin it, and now tell me to go play that game. I mean,
doesn't mean you can't win. It's just, it is
I'm
dangerous.
going to encourage you not to play the game. And I've told the boys, tell you the mid to late 90s was really brutal for me because, you know, it's very similar today. And naturally clients begin to wonder, well, with that stuff doing so much better, is there something wrong? And I'm paid to resist that temptation. Somebody has to be the adult in the room and say, there's no evidence that that works. In fact, the evidence is kind of perverse. It's probably a really bad idea, and you really don't want to do that. I'm always willing to let a few clients walk out the door if that's what it takes, but I'm never going to disserve them by giving them what they want as opposed to what they need. Some people can't handle it. There's a small percentage in the late 90s, mid to late 90s. Yeah, I lost a handful of clients. And when you never lose clients, it makes you, I'm not going to say it hurts your feelings, but it gets your attention. I could have given them the pablum and said, oh, okay, we'll switch. Oh, yeah, we'll give you S&P 500. I mean, that's kind of sick. But that's what the industry is willing to do. I'm not willing to do that. I'm willing to let people walk out. We've had a few clients leave over it. Hey, that's just part of the big boy world and big girl world in our industry. You can't save everybody. Not everybody wants to be saved. I don't want that to sound weird. I'm not trying to be religious. I'm just saying this human nature thing is very powerful. I get it. I'd have to go to the nut house if I took it personally when somebody leaves. I go through some emotions where I feel bad for them because I've lived through it. I've seen the movie. I see how the movie ends. I know I could have easily saved that $5,000 or $10,000 a year fee if I would have just made the switch. That's all they were begging me to do. But again, that's like going, oh yeah, I'm purposely going to let these people do something I know is bad for them. I don't know what you guys would call that, but I call that evil.
Yeah, and I mean, it comes back to, I feel like every first meeting that I've been in with you, you go, I won't put my name on a failed plan.
Right.
And that's what it comes down to. We walk what we talk and we talk what we walk, you know?
Right.
So, I mean, it's not going to be different from us. And I think I liked what Ken French said the best is when he was talking about global diversification.
Tell him who Ken French is so that we know it's not a guy in the corner.
So he's not a Nobel Prize winner, but he just helped, right? But he will be. Oh,
He's one of the most cited people in finance.
yeah.
Maybe no, he and his partner French are the.
Maybe I just took a
Obama.
jab at him. He's going to see
Okay.
this and be like, dang it. Yeah, I know I'm not a Nobel Prize winner yet. But no, you know, but he said, then they're like, okay, like, that's what you think. And he's a little bit of a gruff man. He goes,
yeah.
I don't think anything. He goes, I just gather the data, test it, and tell you what the data says. And he goes, when the data tells me something else, I'll tell you it. But right now, that's what it historically has always said. And I just thought, oh, that's interesting. Just going, I don't think anything. I just look at the data. And that's kind of how we take things. If we thought or knew, if the data showed something else, we'd do it. But the data has never shown anything else than what we've said today. So
I had a conversation with a client the other day, and you know, I've been getting, he didn't ask this specific question, but it was kind of getting at this. It's like, almost, is there anything else we can be doing? Like, just to improve my portfolio, whatever. And I don't want to sound dismissive, but it's like, if there was, we would be doing it. And it's like, I mentioned the quote, there's that saying, I can't remember where it's from, but it's like, capitalism is the worst economic system, except for all the others. I was like, you know, diversified buy and hold investing is kind of like the worst investment strategy, except for all the others. It's like the other approaches to investing, picking stocks, timing the market, that ends poorly. And there's a mountain of evidence that shows people who take that approach end up underperforming buy and hold low cost index fund investors. And that's why we stick with the approach that the evidence supports. If research came out and it said, here are these reliable indicators for what the market's going to do in the future, and you just have to follow these rules and you can figure out when bear markets are going to happen and avoid them, we would follow that. But there's just nothing in existence. And getting back to Ken French, he had another quote too. I can't even remember what it was from, but he was talking about how, you know, in their research, they've looked at, he and his partner Gene Baum have looked at, you know, is there any way to like pick winning managers, you know, mutual fund managers, or time the market, or do any of this stuff? And he's like, I'd like to think with all of our education and resources, we know a little more than the typical person who tries to do these things. And we couldn't find a way to outperform the market through, you know, picking mutual funds or identify mutual funds that outperform picking stocks or timing the market. So it's just, again, it just gets back to you're either making your investment decisions based on what the evidence says is the best approach in the long run over your lifetime, or you're making guesses. And that's what a lot of investing is, and that's what a lot of people do with investing. At the end of the day, is they're forecasting, guessing what the future is going to hold, and then they're shifting their portfolio around based on those guesses.
So I'm gonna, for people, feel free, because we're gonna wrap this up in a minute too. But I'm gonna play just a minute or two of that video, David. I probably watch it several times a year. I'm gonna find it. Dollar cost averaging. Oh, here we go. So let me just play this. I'll speed it up. I'll share it here in a minute. Okay, share. Okay, I'm gonna share the screen. It's worth watching this, and then we'll wrap it up. Share the screen to share. I don't know if you can. Except, can you even hear it?
It's a little quiet.
Okay, turn it up.
By roughly their average fee and expense.
So I'm going to go to the end of it, because really that was the part that always makes me kind of chuckle. Sorry, I should have had this prepared.
When you talk about selecting a manager at random, yet I would expect when investors actually go out to select a manager, they don't assume they're doing it randomly. They're looking at past returns, they're analyzing Morningstar over the weekend. But what you're really saying is, whether they know it or not, they're selecting them at random.
That's almost exactly right. I mean, it's conceivable that somebody has some special expertise at identifying some other manager out there who has special expertise. But gosh, I mean, my co-author, Gene Pham, and I just finished a paper where we were trying to do exactly that. Can we find among all of the U.S. public equity mutual fund managers, can we identify some superior ability in that pool? We failed. And I like to think I'm at least as good as the typical random person who's spending the weekend looking at Morningstar. We have all the data, we have all the powerful computers. We couldn't figure out how to do it. So our best estimate turns out that we can't find them in that bucket. I mean, they just don't appear to be out there. Maybe there's a few of them mixed in, but if they are, they're buried by so many other managers who are underperforming that we aren't able to identify them.
Thank you very much for that, Ken.
All right,
And
Ken, thank you very much for that. Okay, I'll go back, I'll unshare, and then let's wrap it up, guys. We're probably bored people to death. Unshare, where's my unshare? Unshare, stop share, there we go.
So I guess maybe I misquoted. He was talking specifically about picking mutual funds, but I think that the idea behind that
timing.
is
No, there's nobody, there's no credible person suggests that timing works consistently.
right.
But then one of the defaults is, well, I'll go find a superior manager that knows what stocks to be in and what sectors to be in. And he can do it. You almost had his voice right, Daniel.
I know. I thought I did a good job.
Okay, well, I think we'll go ahead and wrap up unless anybody has questions. I don't think there were any. So
I don't think so. Yeah,
I hope
I
it
mean,
was useful.
yeah, it was. I mean, quite frankly, it was even useful for me. Sometimes I got to learn from the panel here too. So yeah, everyone just hang in there. I mean, you're going to be hearing about this Nasdaq versus global diversification thing from us for a while, in the same way that you're going to hear in the middle of bear markets not to sell all your assets. So
Just
these are
like
just
we,
the type
you know
of-
what, Paul? It's like I'm sorry to interrupt, and you hate it when I do that, but I'm dad and I can do it. I shouldn't do it. It's really kind of like saying I have two grandkids right down the street. Ryan's two little guys. It's like I tell them not to run out into the street, and I'll say it over and over and over again until it settles in. So at the risk of kind of like beating this horse from time to time, I think it's that important because it's a real concern is when people chase performance. Sorry, I used my dad card.
That's okay. But yeah, if anything, I want you to take the fact that we're talking about this so much, one, that we get it. We're living through this with you. I mean, don't forget, like, we invest our clients' money this way. We invest our own money this way for a reason, but we do have to live through these tough times together. And on top of that, just don't make any goofy mistakes, and we're here for you at all times. So thanks for bearing with us while we talked about this for maybe a little too long, but I don't think we left any stone unturned. And I guess we'll see you guys in 3 weeks to a month.
All right. Take care, everybody.
Take care.
All right. Thanks. See you later.